Hey everyone, John Bowens here from Equity Trust Company on another Facebook Live session. Very excited about today's program. We're going to be talking about the April 15th tax filing deadline. Now, I'm not here to talk about the tax filing deadline in regards to filing your tax return, filing your 1040 and various other schedules and other strategies around that. What I'm here to talk about is the April 15th tax filing deadline as it pertains to making contributions to your IRAs, 401ks, and various other tax-exempt investment accounts. So we're going to be talking about a variety of different tax savings vessels. Particularly with IRAs, most people aren't aware of the fact that you still have the opportunity to make your maximum contribution for 2018 if you haven't already done so prior to the tax filing deadline of April 15th. Now, I'm going to take it even a step further. As Equity Trust Company works with folks that want to invest in real estate and notes and private equity and other alternative investments with their self-directed IRAs, I'm going to share with you a case study, what I think to be a very powerful case study in the alternative investment space. And this is from an investor here at Equity Trust Company by the name of Brian, that in 2017, we named him the Investor of the Year because he produced over $130,000 in tax-free profits. Let me stop there and say that again, $130,000 in tax-free profits. And he generated these profits across his Roth IRA, his wife's Roth IRA, and then his 3 children's Coverdell education savings accounts. So that's $130,000 in manufactured tax-free income that never hit his 1040 as ordinary income. Folks, this is one of the most powerful concepts in the United States, and unfortunately a concept that a lot of investors are just not all that familiar with. In fact, just yesterday I talked to 2 individuals, 2 completely separate individuals on separate occasions. Both of them have income-producing assets in a Roth IRA. The one gentleman, Jim, has $36,000 in tax-free income coming in every year into his Roth IRA. That means after the qualified retirement age of 59 and a half, he can turn around and withdraw $36,000 tax-free, and it never hits his 1040 as ordinary income. When I asked him, Jim, do you have any regrets? He said, the only regret that I have is that I didn't start this process sooner. See, you only have until April 15th to make this critical contribution if you haven't already done so. So don't wait too long. Now, to help you through this process, you'll find in the comments section, we have a link to a resource page. So as we go through the training here, we have additional education on the various account types that we're going to explore, contribution limits, tax deductibility, et cetera, designed just for you so you can learn more about what may work for you and what might be the best options for you going forward. Now, before I dive into contribution limits and this powerful tax savings case study, I do want to make sure that everybody understands on this training that Equity Trust Company is a passive self-directed IRA custodian. And what that means is we can't provide tax, legal, or financial advice. We're here to be your custodian that allows you to direct your funds to buy real estate in a tax-deferred or tax-free fashion, to make loans to other real estate investors or entrepreneurs, to invest in private equity, cryptocurrency, and various other alternative investment transactions. So it's important that you do your own due diligence prior to engaging in any alternative or traditional investment transactions. So that being said, let's go ahead and jump right into talking about tax-deferred and tax-free income or tax-free savings. All right, every account type, for the most part, is either tax-deferred or tax-free. And what that means on the tax-deferred side, and as you can see here, what I did is I created 2 buckets. Bucket A is your tax-deferred bucket, and bucket B is your tax-free bucket. All right. Now, most people are accustomed to growing their wealth in their retirement accounts in a tax-deferred fashion. What tax-deferred means is when you make a contribution to like a traditional IRA, or as most people are familiar, a 401k, or maybe a thrift savings plan or 403b, they're accustomed to making those contributions and getting a tax deduction. So a lot of people, as they're planning for April 15th, filing their tax returns, they're looking for additional deductions. And so oftentimes we'll find folks will start to look at these tax-deferred accounts, making contributions so that they can get a tax deduction. In just a moment, I'm going to talk about foregoing that tax deduction to create tax-free income. So tax deferred means when you put money into the account, in most cases you get a tax deduction, you grow it tax deferred, and then when you take the money out after the qualified retirement age of 59 and a half, you at that point have to pay taxes. The analogy that's used in the industry is you either pay taxes on the seed or you pay taxes on the crop. So with a tax deferred account, you're not paying taxes on the proverbial seed. After you retire and after 59 and a half, when you start taking withdrawals, you then have to pay taxes on the crop. In contrast, we have tax-free accounts. Tax-free accounts, you put money in after tax, you don't get a tax deduction, it grows tax-free, and when you take the money out after 59 and a half, you don't pay a single dime in tax. Using our analogy, you pay taxes on the seed, so you don't have to pay taxes on the crop. So what types of accounts are there? Now I mentioned the resource page for everyone. You're going to find a deep dive into all of the tax-exempt investment accounts that are afforded to you or afforded to us. All right. Now in the tax-deferred sector, we have a traditional IRA. So most people are familiar with a traditional IRA. If you have a 401k, you have a 403b, you have a thrift savings plan, in most cases you're going to roll that money over into a traditional IRA. The next type of account that you might see in the tax-deferred bucket is a SEP IRA. So for those of you that are small business entrepreneurs, you could potentially contribute significantly higher amounts of money, particularly before April 15th or your tax filing deadline, and get a tax deduction by contributing to a SEP IRA. And there is also a simple IRA for those that are small business entrepreneurs. This is also a small business retirement plan that you can get considerably higher amounts into the plan on an annual basis compared to an IRA, which I'm going to talk about in just a moment. And then last but not least, there's a solo 401k. So for those that have a business, you can potentially establish a solo 401k and make contributions in a tax-deferred fashion. So again, tax-deferred, you put money in, you get a tax deduction, it grows tax-deferred, you take the money out, and you have to pay taxes based on your ordinary income tax rate. Now the tax-free account, again, after tax contributions, it grows tax-free, you take money out, you don't pay any taxes. I mentioned Jim earlier, $36,000 in net tax-free income every single year. That's tax-free cash flow every single year. That $36,000 is subject to a 0% tax rate. No taxes. That amount never hits his ordinary income and then impacts his Social Security provisional income tax. It's all tax-free income directly to Jim. So the tax-free accounts, we have a Roth IRA, which is the most common tax-free account that you're going to hear about. Roth IRA, one of the most powerful tax savings vessels afforded to us by the federal government. Didn't come about until 1997, 1998, whereas IRAs and 401ks go back all the way really to 1974 upon the ERISA Act. A lot of folks are not familiar with a Roth IRA and how powerful this can be, but you can create tax-free income in this Roth IRA, not only for you, but many generations to come. The next account that would fall under the tax-free bucket is the Coverdell Education Savings Account, CESA for short. So for those of you that are looking to save for a child or grandchild's education, you could look at putting money into an after-tax CESA account, and that grows tax-free, and when you take money out and pay for qualified educational expenses, you pay zero tax. All right, another very powerful tool to consider. I also have a case study that I'm going to talk about in just a moment that utilizes a CESA account, in fact, 3 CESA accounts, so stay tuned here. Last but not least, we have a health savings account. Health savings account, some people refer to this account as getting triple the tax deductions or triple the tax benefits. So with an HSA account, you get a tax deduction going in, it grows tax-free, and when you take the money out, so as long as you use it for qualified healthcare related expenses, you pay 0% tax. Another extremely powerful tool in the tax-free bucket. Everything that I'm talking about here, tax deferred and tax-free, it's about creating tax advantage dollars. Those tax advantage dollars create more tax advantage dollars, which create more tax advantage dollars. And what we're doing is leveraging compounding interest in the absence of taxation. All right, I want everyone, if they can write it down or scribe this down, to write this down. Tax-free, tax-deferred what we're doing is we're creating tax advantage profits in the absence of taxation. We're leveraging compounding interest in the absence of taxation. Compounding interest in the absence of taxation. So what happens is when we're making investments, if we're paying taxes, each time we make an investment and we pay long-term or short-term capital gains tax outside of an IRA, ultimately we're going to have to pay tax on that income, and that's going to give us less spending power, less buying power for our next investment. If we're transacting real estate or other investments inside of a tax-deferred or tax-free account, what we're doing again is leveraging compounding interest in the absence of taxation, which can have profound effects over many years to come. All right, now what you see on your screen is what I call the Orbitz Concept. All right, and what this is, and I want everybody to consider this going forward. For some people, as a starter, self-directing into real estate, it might just be a traditional or a Roth IRA. But for other folks, it's going to be more than just a traditional or Roth IRA. You see the centerpiece here is a Roth IRA. I met a gentleman last week on a conference, and this gentleman came to me, who I've known now for 6 or 7 years. He said, "John, the Roth IRA is the centerpiece of my investing. I try to do every single deal that I can," and this is a real estate investor that flips houses and buys rentals. He said, "I want to do every single deal inside of my Roth IRA to my best ability because it's tax-free income. And so that's the centerpiece of my retirement savings." So as we move forward here, be thinking about that Orbit structure. What does your Orbit look like? For some people, it might be a Roth and some covered education savings accounts. For some people, it might be an HSA added in there. But you can start to what some folks refer to as constellationizing, if you will, their retirement portfolio, creating these layers of tax advantage profits. All right, so let me go ahead and move on to how much can you contribute to an IRA, particularly contribute before April 15th, which is the tax filing deadline. Again, you still have the opportunity to contribute for 2018. In 2018, if you are under the age of 50, and by the way, if you know the answers to these questions, I would encourage you to write those in the comments section, okay? Answer these questions as we go along in the comments section. And don't forget, check out the comments section. You can go directly to the link, which is going to give you free access to our resource guide that's going to talk about all these various tax-advantaged investment accounts and how they operate in a self-directed fashion. All right, so for 2018, when you're under the age of 50, you can contribute up to $5,500. All right, that's the maximum amount you can contribute. When you're 50 and over, you can contribute $6,500. All right, so for those that are under 50, 2018, $5,500, 50 and over, $6,500. In 2019, because the cost of living adjustments have went up, the contribution limits for IRAs have gone up as well. So when under the age of 50, you can contribute up to $6,000 to an IRA, and when 50 and over, you can contribute up to $7,000 to an IRA. Now this is for both a traditional or Roth IRA. Now you got to make the decision whether you want to contribute to a traditional or a Roth, or you want to contribute to both accounts. Maybe you want some tax deductions, but you can't exceed the $5,500, $6,500, $6,000, or $7,000 respectively. All right, so again, you got to make the decision to contribute to one or the other, or between the both, you can't exceed those contribution limits. Now, it's important to understand if you're looking to maximize contributions to your IRA. Let's, for instance, say that you're in the real estate business and you're looking to buy properties between $15,000 to $20,000. All right, and you're going to put a few $1,000s worth of work into it and rent them out. All right, and this is a classic example of our clients. You have the opportunity to contribute before April 15th, if you will, double your contributions, assuming that you qualify. So if you are under the age of 50, think you can contribute for 2018 and 2019, $5,500 and then $6,000. All right, so if you're under the age of 50 for 2018 and 2019, you make your contribution all in one fell swoop, you now have effectively $11,500 to work with. Now, as we talked about our compounding interest in the absence of taxation, right, that's $11,500 in manufactured tax-free dollars that you can put to work through investing in real estate and other alternative investments and create more tax-free profits. If you are 50 and over, between 2019 and 2018, you can contribute up to $13,500. Now here's where the Supercharge comes into play. If you have a spouse, even if they're not working, it's just one of you that has to have earned income to contribute to an IRA. You can contribute for your spouse in 2018 and 2019. So consider that. You're under the age of 50, you got $23,000 in tax-free dollars created. Let's call it in a Roth IRA. If you're 50 and over, between you and your spouse, you have $27,000 in tax-free dollars that you can create. Here's the reason why I say this. I mentioned before a gentleman I talked to yesterday, 2 individuals in fact, and they both said my biggest regret is I didn't start this sooner. So you have an opportunity to take a look at creating more tax-free dollars in a very short period of time. But you only have this short window before April 15th to do so. All right? So let's go ahead and move on to our case study. So this is Brian. Brian was named our, as I said before, Investor of the Year in 2017, creating $130,000 in tax-free profits. Here's how he did it. Deal number 1, Brian bought a piece of land for $8,000. Vacant lot for $8,000. The way he put the deal together is he funded the transaction with each of his children's Coverdell education savings accounts. So as I talked about before, the Coverdell education savings account falls into that tax-free bucket. Money goes in after tax, it grows tax-free. When you take it out and use it for educational expenses, you don't pay any taxes. So bought the land for $8,000, and he did a partnership between all 3 Coverdell education savings accounts. He put $2,000 for CISA 1, $2,000 for CISA 2, and $4,000 for CISA 3. All right, so $8,000 in the deal. CISA number 1 had 25% ownership interest in the deal. So on the purchase contract and on the deed to the property, CISA number 1 had 25% ownership interest as tenants and common owners. CISA number 2 with $2,000 in for the $8,000 had 25%. And then CISA number 3 with $4,000 invested had 50%. Now, when he put this transaction together, he had all 3 CISA accounts on the contract as tenants and common owners. 25, 25, and 50, 4,000 in, 2,000 in, 2,000 for the $8,000 purchase. Within 90 days, he had a sale of that property in settlement, which then returned a $60,000 sale for a profit of $52,000 tax-free. This $52,000 never hit Brian's 1040 as we're talking tax time, April 15th. That $52,000 never hit Brian's 1040 as ordinary income. I'm speaking very, very passionately about this because there are a lot of Americans out there that don't understand how powerful this concept is of sheltering income inside of a CISA, Roth IRA, or other retirement account and it not hitting the 1040 as ordinary income. Okay? $52,000 in profit on that one deal. Now let me rewind a moment. In 2017, Brian contacted us in that window between January 1 and April 15th. And what he did is he made a contribution for 2016 and 2017 to each one of his children's Coverdell education savings accounts. So each one got $4,000 into the plan. Had $4,000 for the first child, $2,000 for child 2, and $2,000 for child 3 in order to put that transaction together. So again, he was leveraging the April 15th tax filing deadline. All right, let's go to the last case study here. This is the second transaction that Brian did. And this is what took the entire portfolio balance, if you will, from where it was at to over $130,000 in profit. So on this transaction, he found another lot, and it was in a very similar location as the first lot that he had bought. So it was a similar location, bought a second lot for $120,000. And the way he put this transaction together is he partnered not just the 3 CISA accounts from the first deal, but he reloaded with these CISA accounts on the first deal and put it into the second deal, leveraging compounding interest in the absence of taxation. See how that comes into play again? So on this next transaction, bought the property for $120,000. On the deed to the property, he had CISA number 1, CISA number 2, CISA number 3 from the first deal, and then he had his Roth IRA and his wife's Roth IRA in the deal. So he had 5 investment accounts all partnered together on the transaction. Sold the property for $200,000 made a profit of about $80,000. And this profit, when the property sold and the title company sent the wire transfer back into Equity Trust Company as custodian, that $80,000 was dispersed into each one of these respective accounts, proportionate with the capital contribution. Now that's a critical piece of information. I know there's some naysayers out there right now that are already commenting down below, all right? They're going to tell you that you can't do it. It's important to understand that the reason why this worked the way that it did is because Brian had all of these retirement plans involved proportionately. See, when you're partnering with what they call disqualified persons, for all intents and purposes, family members, it's important that the capital contribution is proportionate with the ownership interest. As a for instance, going back to this example here, CISA number 1, CISA number 2, and CISA number 3. All right, you see I broke it out. $4,000 in the $8,000 investment gives 50% equity, 25 and 25. So when partnering, for all intents and purposes, with immediate family members, it's important that everything is done proportionally. If you have more detailed questions about this, we could certainly provide more information and guidance. Again, we're not your tax advisor or CPA, so if you are going to be partnering with disqualified persons, it would be important for you to be consulting with those appropriate individuals. So again, in recap, going all the way back to our first section, we talked about tax-deferred growth, we talked about tax-free growth, and we really spent a lot of time focusing on that Roth account and that CISA and that HSA, right? I told you the story from the very beginning about Jim, $36,000 in tax-free income coming in every single year. Never hits his 1040 as ordinary income. He's creating a tax-free lifestyle. Some of our clients refer to that as. We talked about contribution limits. Remember, you can't go back after April 15th. You can't go back to 2018 and make a contribution. I can't tell you how many times I have investors that call in every single day and say, gosh, I wish I would have made that contribution for 2017. Gosh, I wish I would have made that contribution for 2016. Some folks even ask, hey, John, can I go back 3 or 4 years and make contributions? Or can I just take $100,000 and put it into an IRA? You have to abide by these contribution limits. Now, earnings, like we talked about in Brian's example, are unlimited. You can grow the account exponentially without any limitations. It's just how much money you take out of pocket and put into the plan, you're limited by these numbers. But before April 15th, you have the opportunity to potentially double up on your contributions, and I would encourage folks to take advantage of that. And then last but not least, we went through our case studies. We have a lot more case studies to share with you. If you're interested in more information, in the very bottom comment section, you're going to see a link. I'd encourage everyone to go to that link, all right, and download the information that we're sharing with you. It's all free of charge. We created this resource page specifically for people that were tuning in to this Facebook Live demonstration. I can give you a case study after case study after case study of clients that have partnered multiple IRAs together. I have a client that partnered up to 10 IRAs and investment accounts on one transaction. He made a loan to a mobile home park operator on an equity participation basis. 10 IRAs and investment accounts. Going back to our constellation slide, if we could pull that up briefly just for a second, he had 10 of these molecules in his portfolio, made a loan, and all the interest and principal payments were flowing back into each one of the respective investment accounts. So these are the types of things that folks can consider and folks could utilize. Don't wait too long. Again, I mentioned at the very beginning, the biggest regret that I hear from investors is they didn't start this sooner on in the process. And last but not least, if you like this, if you want to share this with other investors, I would encourage you to share this with other investors, or at minimum, just like this Facebook Live post. Because here's the deal, folks. There's not enough people out there that understand this. Again, I mention it time and time again about folks that regret they didn't do this sooner. So even if you don't take action on this, you don't make your contributions, you don't take advantage of all this tax-free income you could potentially create, if you can just like this or share this with someone that can be, that they find it useful, we would appreciate that. And ultimately, that will help more people understand the possibilities of this and create less regret in the future. So thank you again for joining us in today's Facebook Live session, and we look forward to seeing you on the next program.